Mortgage rates are sharply increasing just in time for the spring housing season. What will the impact be? I'm Sean Engmann, an MBA and certified real estate negotiation expert. If you like my content, please hit the subscribe button or drop a comment below. Let's start by putting into context where the rates are right now. As of March 30th, the average 30-year fixed rate sits at 4.79%, according to Mortgage News Daily. That's off from 4.95% as of Friday the 25th, but still up over 3/4 of a point from the beginning of March, up 1.5 points since the beginning of this year, and up 2 points since last year's low of 2.78% in August. To put things into historical context, rates right now are at their highest level since November of 2018. Before that, the last time rates exceeded 5% was in February of 2011. The increasing mortgage rates come on the heels of a 1/4 point increase in the primary credit rate by the Federal Reserve on March 17th, the first increase since December of 2018. The Fed also revised its earlier projections of 3 rate hikes in 2020 and now anticipate an additional 6 hikes this year to combat rising inflation. That means that the days of historically low interest rates are now behind us. So what does it mean for the housing market here in the Bay Area? Well, first-time buyers and move-up buyers in need of financing will be hurt the most. To put things into perspective, the monthly payment on the maximum conforming loan at current rates is $5,088. That's a staggering $509 more expensive than it was just at the beginning of March, $842 more expensive than it was at the beginning of this year, and incredible $1,109 more a month now than it was for those who bought last August. Not only are loans more expensive now, it also becomes much harder to qualify for a loan because the increased monthly payments increase the debt-to-income ratios, which lenders use to approve buyers for their loans. That means that the amount of money that buyers can qualify to borrow is significantly less right now, which lowers their cap on the purchase price. At the same time, while rates have increased by 2 points since August, home values in the Bay Area have appreciated by 11.3% over the same span. That means that buyers who could have bought in August but decided to wait to hold off to see if the market would cool off or to save for a bigger down payment will now face a much more expensive purchase, and many may have even been priced out of the market completely. As an example, let's take a house that was available in August, hypothetically, for $1 million. A 20% down payment would have been $200,000, and the monthly mortgage payment would have been $3,279. Given average appreciation, that same home is now worth $1.113 million, meaning that the down payment increased by $22,600, and the monthly mortgage payment is now $4,666, an increase of $1,387 per month on the exact same house. Additionally, there's the opportunity cost of $113,000 in equity, more than half the down payment. Since housing prices are a function of supply and demand, will rate hikes impact buyer demand enough to slow the market down? My answer to that for most of the Bay Area is no, because inventory remains so low. The absorption rate is used to measure demand by dividing sales per month by the number of available properties. Generally speaking, an absorption rate above 33% is considered to be a seller's market. In San Mateo and Santa Clara counties, the absorption rate for February was 143.4%. In order for the market to slow down, supply will need to increase and demand will need to fall off. Throughout the Bay Area, supply has been trending down since September of 2019. Inventory of single-family homes in February throughout the Bay Area was only 2,428, which is a 25% decrease year over year. In fact, year-over-year inventory in the Bay Area has declined 26 months in a row. There are many factors why inventory is continuing to decline, and that's the subject of another video, but the bottom line is that even with an expected decline in demand due to increased interest rates, all the metrics point to the market continuing to be a very strong seller's market and for home values to continue to appreciate as a result, though likely at lower rates than what they've been doing over the past 2 years. To those expecting a market correction like in the 2008 bubble, I don't see that happening. The fundamentals of the market are different now. Unlike in 2008, where there were a lot of bad mortgages out there, there aren't now, and people hold substantial equity in their homes now. With economic conditions that may lead to some defaults, I don't anticipate a large number of foreclosures or short sales, even so. In certain pockets, we may see markets emerge that are more favorable to buyers than has been the case right now. I expect to see that to start to happen in the San Mateo County Coastside, where a good number of people in the market have been buying second homes and taking advantage of great rates to do so. With demand lower than on other areas in the Peninsula, the market there may slow down a bit. The condo market also has been weaker than the general housing market, and I believe that is likely to continue to soften, especially outside of San Francisco. This spring, we're likely to see more homes on the market, and inventory may tick upward for a couple of reasons. One reason is that some sellers may think that we're at the top of the market and decide to sell for fear of losing equity. Another reason is that refinance rates are increasing along with just the regular mortgage rates. That's making it more expensive to borrow against a home's equity. It remains a great time to sell, especially for people in need of additional cash or if they're looking to move out of state. The impact of rate increases everywhere else in the country may turn those areas into buyers' markets, especially for buyers in strong cash positions. For buyers looking to get into the market, I think it's critical to move quickly right now before rates and appreciation price you out of the market completely. If you're waiting for the market to soften, in my opinion, you're making a bad bet that will cost you lots of money as rates continue to increase and home values appreciate. Rates still remain relatively low from a very long-term historical perspective and figure to get considerably higher. Thanks for watching. If you liked this video, please hit the subscribe button and feel free to leave a comment. I have some great resources for buyers and sellers in the description, including a link to my calendar if you'd like to connect with me one-on-one. Thanks a lot, and I look forward to seeing you in the next video.